best FP&A leaders don't just crunch numbers. They understand how to analyze and present the right metrics that lead to making the right decisions in the company. Now, in the last couple of years, I've helped over 1,000 finance professionals master these skills through my courses and workshops, including teams at Google, Merck, and Lowe's. So in today's video, I'll break down the 10 most important KPIs every FP&A professional should know and how to use them to become a strategic advisor to your business. But before diving into the KPIs, let's talk about how companies organize their financial data. That's crucial to know what to analyze and how to get the data. The most important aspect you need to learn here is that of the chart of accounts. This is just a fancy way of saying that all your accounts are grouped into buckets: your assets, liabilities, equity, revenue, and expenses. Most companies don't stop here. They add more layers like legal entities, cost centers, departments, and business unit. Think of it as rows and columns in a spreadsheet where the rows are your accounts, like marketing expenses, production costs, or salaries, and the columns are categories like the region of North America or the product category automotive. Now, wrapping your head around the large number of financial ratios gets significantly easier if you realize that there are really just 5 categories of financial metrics. There are liquidity ratios. Can you pay your bills next month? There are leverage ratios. How much debt are you carrying? Then there are efficiency ratios. Are you getting the most from what you have? Profitability ratios. Are you actually making money? Market value ratios. What does the market think you're worth? Before I get into the actual KPIs, if you're looking to improve your FP&A skills, I'm currently giving away my 10 most popular one-pager infographics completely for free. Just click the first link in the description to get them. So the first important KPI in the liquidity ratios category is working capital. It's the money you have available to run day-to-day operations, and it's calculated by subtracting current liabilities from current assets. And this metric matters because positive working capitals means you have more money available to pay your bills and invest into your business. Next, we have the current ratio. It shows whether you can cover short-term obligations, and the math is current assets divided by current liabilities. Here you want to aim for at least a 1-to-1 ratio. If you're below that, you might be in trouble. Next is the quick ratio. It's the same as the current ratio, but without counting inventory. And it's useful because it shows if you can pay the bills without selling inventory, which can sometimes be a bit harder to sell depending on your situation. And when should you worry? Well, if this is significantly lower than your current ratio. The next category of metrics are the leverage ratios. One of the most popular is the debt to equity ratio. In simple terms, it tells you how much you're borrowing versus using your own money. And you can find it by dividing your total debt by your total equity. And if it's too high, you might be in too much debt. Then there's the debt to assets ratio. It shows what percentage of your stuff is bought with borrowed money, and the simple calculation here is you take your total debt divided by total assets, and higher numbers mean you're more vulnerable if things go south. Then we have efficiency ratios. You want to start looking at the asset turnover ratio here because it shows how good you are at using your assets to drive sales. It's calculated simply by taking revenue divided by the average total assets. You can get that from your balance sheet. And higher numbers here mean that you're squeezing more value from what you own. Then we have inventory turnover ratio. It shows how quickly you're selling and replacing inventory. It's calculated by taking the cost of goods sold divided by the average inventory. If this metric is too low, it might mean that you have inventory sitting in your warehouses that isn't moving fast enough. And if it's too high, it might mean that there's a risk for running out of stock. And where the sweet spot is depends on your unique circumstances. There is no ideal inventory turnover ratio, because a change here might not necessarily mean that you're running out of inventory, but it could simply mean that the company is selling more quickly, so strategies are working, and then you're using this ratio to adjust your supply chain to make sure that the level of inventory adjusts according to how fast you're selling things. Then we have days sales outstanding. It tells you how long customers take to pay you. So this is what the math looks like. You take the accounts receivable divided by the revenue for a given period, let's say a year, and then you multiply that with the number of days in that period, so 365 if you're looking at the whole year. Lower is better here. It means that cash is flowing in faster. The next category of metrics are profitability and return ratios. And here we have return on assets. It's often abbreviated as ROA, and it shows how well you're using assets to generate profit. You calculate it by taking your net income from your income statement and dividing that by the average total assets from your balance sheet. A higher ROA means you're getting more profit from your assets. Next, we have return on equity, ROE. It tells you how efficiently you're using your shareholders' money, essentially. That's what it is. And you calculate it by taking your net income divided by the average shareholders' equity. And it's important because it shows investors what they're getting for their investment. Now, knowing these metrics is just a small part of the equation here. If you want to use KPIs to help leaders make better decisions and do that consistently, then a single source of truth is a must. And I want to share a story to illustrate what that means. So when I worked at software as a service company a few years ago, I learned a painful lesson. I was presenting our funnel analysis to the leadership team. So that means looking at how many people visit our website and how many people of them sign up to our free trial. And then again, how many of those buy our product. This funnel analysis is important because we want to understand how well is our marketing working, and then how well is our product working to convince people to actually buy it. And so we had a big meeting with the other heads of departments around us. I was, working on this analysis with my team for months. We were very well prepared for this meeting. And it was a bit of a stressful situation because I had to make a point that, the business isn't going as well anymore as it used to. And so I was presenting the funnel analysis, and I was presenting how the conversion of website visitors to free trials has declined over the last period, suggesting that our marketing investment isn't working as well anymore. Right when I was in the middle of it, and I had a really nice slide with great visualizations on the screen, the head of product jumped in. "These numbers are wrong," he said. And from then on, the whole meeting essentially went off the rails because the discussion was just about what the right numbers are and not about whether the marketing investment is working and what we should be doing about this. That was the whole goal, to help leaders make better decisions around marketing return on investment. And so after the meeting, of course, I immediately went deep into the data, double checked whether we made any mistake. We didn't make any mistakes with our model. But when I compared my numbers to the ones that the product team were looking at, I realized that they were looking at different numbers. And the issue wasn't that the data was bad, it was that the definitions were different. So my team, we counted website visitors one way, and the product team counted them another way. Because the thing is, when someone only visits a website for 1 or 2 seconds, we didn't count those visits, but the product team did. And so we ended up getting completely different conclusions from those numbers. And so to address this, we had to agree on a shared definition of what a website visitor really means. There was some back and forth there, and we lost a lot of time just getting to that shared definition. And we could have avoided all of this if we had a shared source of truth, a one source of truth for all metrics and their definitions. So I highly recommend that you build that upfront so that you avoid those discussions, because if you can't agree on what you're measuring, you definitely can't make good decisions. So now you know the most important KPIs to track as an FP&A FP&A professional. But of course, understanding these metrics is just a small piece of the puzzle that you need to master if you want to become exceptional in this field. That's why I decided to give away my 10 most popular FP&A one-pagers. These are concise visual guides to the most important concepts in financial planning and analysis. You can just click the first link in the description to get them. Plus, you'll also join my weekly newsletter where I share practical advice on forecasting, budgeting, financial modeling, and more with over 30,000 finance professionals every week. So click that first link below to get instant access to these resources. Thanks for watching, and I'll see you in the next video.